Hello, with me today I have Ashley Kelty, Director and Oil and Gas Research Analyst at Panmure Gordon. Hi, Ashley.
Hi, how are you?
Very well. On the oil markets, it's really interesting to understand who's actually pulling the strings on international oil markets. Obviously, there are lots of actors involved. I mean, the Saudis, the big swing producer for decades now, the US, OPEC, lots of others. Um, who are who is the most important player at this time on the international oil markets?
I think what we have seen in recent months is how the commodities market are driven by sentiment rather than fundamentals. And that's certainly been, I think, clarified in recent months. The US, I think, last year would have been a bigger player. However, the muddled foreign policy of President Biden has not helped their position, and I think he arguably looks weak at the moment. I think the panic over fuel prices ahead of the midterms and the surprise 180 million barrel release from the strategic reserve, I think certainly weakened the US position markedly. I think as a result of that, following the reaction we had from the surprise cut in OPEC, has handed the initiative back to OPEC. However, it is worth realising that OPEC have failed to meet their quotas at any point in the last 18 months, and the reductions that they've announced means that it is just more likely that they will actually meet their targets. And whilst they are effectively notional, they do drive markets, and I think at the moment OPEC has the whip hand in terms of driving prices higher or lower. I don't think OPEC want prices over 100. I think that is too high. I think they would be concerned about the impact on inflation and choking back the nascent global recovery. I think they would be happier with a sort of $80 to $90 barrel price, and that would allow them to meet their domestic needs while still having control of the markets.
And in terms of oil prices, what's your view for the next 12 months? Where do you think we'll be this time next year?
I'm certainly bullish in oil prices. I think we'll see them above $90 later on this year. They could even reach $100. However, I don't think we'll see sustained levels above $100. I think OPEC would increase their supply if it did get above 100. I think they want to choke it back somewhat in order to ensure that the Chinese recovery continues. I don't think they'd want to push too hard for a short-term gain, which could slow down the global recovery. So I think, yes, $80 to $90 would be happy for them. They balance the books, and that would allow them to keep control that they have just now.
Those high oil prices, higher oil prices, might be good for companies, the drillers, the explorers, the production people. So, I mean, which companies do you think will deliver the strongest returns over the next year? Do you have a favourite large cap oil play and some small cap ideas?
I think there's been a slight shift in the way people are viewing companies. I think last year, when gas prices were so high, I certainly would have been advocating overweighting portfolios towards companies that are focused more on gas. However, with the recent increase in oil prices and weakness in gas prices, I would be advocating a more balanced approach at the current time. However, the outlook is complicated further by the sort of windfall taxes and increased taxation levels that have been imposed, certainly in the UK, and have been proposed in Europe. I mean, certainly in the UK, the energy profits levy is it's not a windfall tax. It's in place till 2028, and I think that has certainly hampered the outlook for UK companies, and it will be companies that are able to undertake projects and or exploration that will be able to take advantage of the investment allowance, which will allow them to defray a lot of the impact of the energy profit level or levy. I think we can see that with the likes of Serica, its acquisition of Tailwind, which rebalanced their portfolio, but it also gave them opportunities to invest. The sort of previous Serica portfolio had little in the way of material projects or exploration, and they weren't able to really actively invest to affray the EPL. However, now with Tailwind, they've got some sizable prospects and projects that will allow them to spend some money to grow and mitigate the tax. They're also more balanced in terms of oil and gas, as opposed to being primarily a gas producer. I think the terms of the EPL and the negative downside have been highlighted by the likes of Harbour and Enquest, who have complained bitterly, and we've been able to see it in the impact on their financial results with the huge increase in tax paid. However, I think Harbour have made an interesting move with their sort of push into the Viking carbon capture project alongside BP, which looks very interesting, and I think having BP on side will also help massively in terms of getting government support for that, as that's two sizable UK companies that are pushing the project. Some of the other ones are led by smaller independents, and I suspect that the government will be much keener to go for well capitalised, experienced operators for that. So I certainly see the Viking project as being in pole position for receiving government funding. In terms of other companies that look interesting, I think Kistos looks very good. It has a diverse portfolio in the UK and Netherlands, and it's got a high impact West of Shetland well later this year, which will allow them to offset the impact of the energy profit level. And they've been highly acquisitive, and I would imagine that they should do another deal in the near term if they can get the terms right. M&A hasn't been destroyed by the EPL as people feared. We've seen that with Jersey Oil and Gas managing to get a farm out recently. That's a big project for the Greater Buchan area, and will certainly help to contribute to future energy security for the UK. There's other projects in a similar vein, albeit smaller, such as with Arcadian Energy. But outside the UK, I like Jadestone Energy in Asia. They had a difficult year last year with the closure of one of their fields on the back of a very, very small oil leak, and it's taken time to get that back onto production. That has now come on stream, although the shares were, I think, oversold, and I think that there should be a good recovery in the share price this year. It's also worth noting that Jadestone also receives a sizable premium to Brent for their Australian crudes, which is the bulk of their production. And this helps cushion them from any softness in commodity prices that will impact peers. In terms of Africa, I think Cosmos Energy looks very interesting. They've got some good portfolio assets in West Africa, and they've also got the large Tortue LNG project that should come on stream towards the end of this year, and they've also got some interesting discoveries and developments in the Gulf of Mexico. They're certainly partnered alongside perennial favourite Tullow, which seems to be going backwards at the moment, but I do think that if you want exposure to West Africa, Cosmos is definitely the player for that. In terms of the majors, I would prefer BP over Shell. Both are sort of well capitalised and have significant projects in the pipeline to allow them to keep generating huge profits and paying a sufficient yield. But in terms of longer term strategy, I think BP is a bit clearer. Shell doesn't seem to have quite decided what it wants to be and what direction it is heading in. And as a result, I think I would favour BP over that. I think an example of the Viking carbon capture project that I mentioned earlier shows that they are willing to invest in the UK and in new technology. So certainly they would be my preferred major.
Great. Ashley Kelty, Director and Oil and Gas Research Analyst at Panmure Gordon. Thanks very much for joining me today.